Is the Pramerica Life Wealth Enhancer Plan truly the growth booster your portfolio needs, or could it leave your wealth underperforming? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a unit linked, non participating individual savings life insurance plan. And some of the key features of the policy are you can make a one time payment and enjoy benefits for up to 20 years, and you can also receive wealth additions starting right from the first policy years. You also get wealth boosters at regular intervals to enhance your fund value. You can choose the fund conservation option to protect your investment from market volatility. You can also manage your portfolio efficiently with the life stage portfolio strategy, which balances equity and debt funds based on your age. And there are also tax benefits applicable on your premiums paid and benefits received, which is subjected to prevailing tax laws. So these are some of the key features, and there are benefits like death benefit, maturity benefit, and wealth additions and wealth boosters. So as I have previously mentioned, there are two investment strategies and also fund options where there are 10 fund options available for you to choose from based on your risk tolerance, your financial goals, and your time horizon. But as a unit link policy, they also charge you with various charges like premium allocation charges, policy administration charges, mortality charges, fund management charge, discontinuance charge, and switching charges. So these charges are applied throughout the policy term, so thereby reducing the portion of your premium that is actually invested in the policy. Over time, this leads to lower compounding benefits and can significantly impact your long-term wealth accumulation. So these are something that you need to keep as a drawback before deciding to invest in this policy. Now let us take a look at the advantages. So the defined portfolio strategy allows you to switch investments among the available funds, and partial withdrawals are permitted only after completing 5 policy years, which serves as a lock-in period. And you can also choose to receive your maturity benefit, a structured payout spread over up to 5 years after maturity through the settlement option. So these are some of the advantages. However, there are some disadvantages like loans are not available under this policy, and this plan offers no liquidity during the initial policy years, and the sum assured provided is also inadequate for comprehensive financial protection. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the benefit illustration given in the policy brochure to help us make a more informed decision. But if you still want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So now, for calculation purpose, let us assume that we are going to consider a 30-year-old male has purchased this policy with a 20-year policy term, and he is going to pay a single premium of 5 lakhs. So the sum assured is 6 lakhs 25,000, which is 1.25% x the premium. So at maturity, the fund value will depend on the assumed return rate given in the policy brochure, because in the policy brochure they have given 4 and 8% returns, which are assumed returns and purely just for example purpose, not guaranteed, and nor do they reflect any maximum or minimum possible return. This is just to show you how this policy can perform at worst and best case scenarios. So at 4% assumed return, fund value is 9.19 lakh, giving an IRR of 3.09% as per the policy's maturity calculator. So practically no wealth creation is present here, as the returns are extremely low. And at 8% assumed return, fund value rises to 19.39 lakh with an IRR of 7.01% as per the policy's maturity calculator, which is still lower than typical debt instruments, highlighting limited growth potential. So in this analysis, it clearly indicates that this policy can deliver minimal real returns, which can hinder your long-term wealth accumulation process. For a lump sum investment, there are far superior options that offer better returns and greater flexibility. So now as we know that this policy is not giving us the desirable outcome that we need, let us move on to a comparative analysis where we are going to take up an alternative approach in which we are going to invest in insurance and investments separately. So here for insurance, we are going to take up a pure term life insurance policy with 6.5 lakhs coverage for 20 years, which can be brought for a single premium of 31,300 rupees. So this leaves us with 4.68 lakhs available for investment. So depending on your risk preference, this amount can be allocated to either debt or equity investment. So if you're a low risk investor, you can choose fixed income or debt products, and if you're a growth oriented investor, you can invest in equity mutual funds. So assuming the 4.68 lakhs is invested in an equity mutual fund over 20 years, the pre-tax maturity value grows to 45.21 lakhs. So after accounting for long-term capital gains tax, the post-tax value is 40.30 lakhs. And if you have any doubts regarding how the tax for equity mutual fund was calculated, we do have presented a small tabular column on the screen for your easy reference, which you can pause and see. So the combined post-tax IRR from both the equity mutual fund and term insurance comes to 11%, which is significantly higher than the IRR offered by the policy. So this alternative approach provides you with higher returns, better liquidity, and more efficient wealth creation, areas where the Pramerica policy falls short. So what is the final verdict then? Is investing in the Pramerica Life Wealth Enhancer plan worth it or not? So this is a single premium ULIP plan with two options. So plan option A provides a death benefit of 10x the premium. Plan option B offers a death benefit of 1.25x or 1.0x the premium. So both options provide the fund value at maturity, including wealth boosters and additions, but the plan lacks any distinctive or standout features, and it also has a high agent commission. So in terms of return, the plan is not impressive for long-term wealth creation because the charges are deducted from your premium and some even continue throughout the policy term, which hampers with the corpus growth. Despite its name, the plan does not effectively enhance wealth. Additionally, the sum assured is inadequate for securing a family's financial needs, where a pure term life insurance policy, by contrast, provides much higher coverage at a fraction of the cost, freeing up funds to invest in high growth instruments like mutual funds or other market linked products aligned with your risk profile. By selecting the right investment avenues, ideally with guidance from a trusted financial advisor, you can achieve your financial goals more efficiently and with greater confidence.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.